Financial and Managerial Accounting, Chapter 16, Introduction to Managerial Accounting. We're going to define managerial accounting and understand how it is used. So, why is managerial accounting important? Members of the Pathway Commission created a vision model to help students and the public understand what accounting is. Accounting starts with economic activities that accountants review and evaluate using critical thinking and judgment to create useful information that helps individuals make good decisions. Good decisions influence accounting judgments and economic activity, thus creating a circular flow of cause and effect. Managerial accounting uses basic accounting concepts learned in previous chapters, such as Accounting 201 and the previous chapters of this book, and introduces new tools that can be used to make good business decisions. Financial versus managerial accounting. Planning means setting goals and deciding how to achieve them. A tool used by managers is a budget. A budget is a financial plan that managers use to coordinate a business's activities. The budget is used to identify resources needed to achieve the business's goals. Implementing plans and evaluating the results of business operations by comparing the actual results to the budget is called controlling. Controlling involves evaluating the plan and comparing the actual results to the budget. Managers weigh the benefits of the system against the cost and benefit analysis to develop and run the system. Weighing the cost against the benefits is called cost-benefit analysis. So with financial accounting, we use financial statements, and people that use those financial statements are investors, creditors, and government authorities. With managerial accounting, where managers, internal users, are using reports for planning. And a planning tool that we use is the budget. Financial versus managerial accounting. So we see here, we're comparing financial accounting to managerial accounting. We see that our primary users for financial accounting are external users, and for managerial accounting, they're internal users. So examples of external users are investors, creditors, government authorities. Managerial accounting primary users are internal. So when you think of internal, inside the office, you've got your managers, upper management that's using these reports generated through managerial accounting to make good business decisions. The primary users of financial accounting information are external users such as investors, creditors, and government authorities. External users make investment and lending decisions based on financial statements, such as your income statement, your balance sheet, statement of cash flow, profit and loss. Financial accounting reports the past results of the company. The information must be prepared in accordance with generally accepted accounting principles, also known as GAAP. Businesses prepare financial statements both quarterly and or annually. In managerial accounting, on the other hand, it focuses on internal users, such as managers and employees. The information reported is intended to help managers with planning and controlling. With managerial accounting, they focus on the future. It does not have to follow GAAP. And managerial accounting reports are more detailed than financial accounting reports, providing information about product lines, departments, or territories. Reports generated by managerial accountants are used to help guide management decisions for the organization. Management accountability is the manager's responsibility to the various stakeholders to wisely manage the organization's resources. Stakeholders include Customers, creditors, suppliers, and investors. Stakeholders are people that have an interest in the business. Management accountability. Suppliers provide products and services to the organization, and managers are responsible for making timely payment to these stakeholders. Managers are responsible for providing safe and productive work environments along with competitive wages to the employees. Managers are responsible for providing safe products and services that are free from defects to the customers. Investors expect the company to provide a return on their investment, and managers must act in the best interest of the organization to generate profits. Management is responsible to the creditors to make principal and interest payments on time. When you shift toward a service economy, we have global competition and we have time-based competition. Under time-based competition, we have ERP, e-commerce, and JIT. ERP is Enterprise Resource Planning. ERP systems integrate companies' data. E-commerce allows companies to sell products to customers around the world. And JIT, just-in-time management, is an inventory management tool. The Office of the United States Trade Representative reports that service industries account for 68% of U.S. gross domestic product and 4 out of 5 U.S. jobs. Service companies provide healthcare, communication, banking, and other important benefits to society. Total quality management, also known as TQM, is a philosophy of continuous improvement in products and processes. It creates a culture of cooperation. Each step adds value to the end product and is referred to as the value chain. The economic and social environmental impact of doing business is referred to as the triple bottom line, which includes profits, people, and planet. Ethical standards. Ethics are very important in business. So some examples of some ethical standards are competence, confidentiality, integrity, and creditability. The Institute of Management Accountants developed standards managerial accountants should follow when they face ethical challenges. The IMA, Institute of Management Accountants, Statement of Ethical Professional Practice requires accountants to maintain professional competence, preserve confidentiality, and act with integrity and credibility. Describe differences between service, merchandising, and manufacturing companies. How do service, merchandising, and manufacturing companies differ? Service companies sell their time, skill, and knowledge. All of their costs are period cost and are expensed in the period that they are incurred. Merchandising companies resell products they previously bought from suppliers, such as cost of goods sold is an inventorial product cost. And then manufacturing companies create products that customers want. The 3 categories differ in what they offer to the customer. Manufacturing companies convert raw materials into finished products. The 3 types of inventory are raw materials inventory, work in process inventory, and finished goods inventory. Raw materials inventory are the raw materials that are used to manufacture a product. Work in process inventory are the goods that have been started but are not complete. And finished goods inventory are the completed goods that have not yet been sold. So a good example of this would be baking a cake. So you have your raw materials, which are your flour, your sugar, whatever ingredients that you use to make that cake. And then when you start mixing all of those ingredients together, now you have a work in process. You are working to make that cake. All these ingredients are being mixed together. And then after you've baked the cake and it's done, it's ready, now you have a finished good. How do service, merchandising, and manufacturing companies differ? So here we're going to compare the financial statements of the three different types of companies. So we're looking at income statements and balance sheets for service, merchandising, and manufacturing companies. As we see here, service companies do not report inventory. Merchandising companies report one type of inventory, which is merchandise inventory. And then manufacturing companies report raw materials inventory, work in process inventory, and finished goods inventory. Now we're going to classify cost for service and merchandising and manufacturing companies. How are costs classified? Costs can be classified as either a direct or indirect cost. A direct cost is easily and cost-effectively traced to a cost object. A cost object is anything for which managers need a separate breakdown of its component cost. Some examples of cost objects are product, a department, a sales territory, or an activity. In manufacturing, cost objects are usually units of product. Indirect cost, on the other hand, cannot be easily or cost-effectively traced to a cost object. For instance, the salary of the production supervisor is an example of an indirect cost. The production supervisor manages the factory operations for all of the products the company manufactures. Therefore, it's difficult to trace the cost of the supervisor to a specific product. A manufacturer's product cost includes both direct and indirect costs. Product cost. Direct materials, also DM, are the raw materials that are used in production. Direct materials consist of raw materials that are converted into a finished product. They can be easily and cost-effectively traced to the product, so they're considered to be direct cost. Direct labor, also DL, is the labor of the employees working on the products. Direct labor is the labor of the employees who convert raw materials into finished products. It's a direct cost because it can be easily and cost-effectively traced to the product. Manufacturing overhead, MOH, is an indirect product cost associated with production. Manufacturing overhead includes indirect materials, indirect labor, and factory costs such as rent, utilities, and insurance. It includes costs that cannot be easily traced to specific products. So we're looking at this diagram 16.6, period and product cost. And we see here we have different costs that have been incurred, such as advertising, the CEO's salary, wages. Those are the costs that we've incurred. And then we have period cost and product. Our period cost are our selling and administrative cost. And our product costs are direct materials, direct labor, manufacturing overhead. So here what we are doing is we are noting where the cost allocation is for each of these costs that are incurred. For instance, advertising is going to be put to our period cost because it's a period cost under selling and administrative. When we look at the CEO's salary, that's also going to be a period cost. And then when we look at manufacturing supplies, that's going under our manufacturing overhead. So this just kind of gives you an idea of where the different types of cost incurred would go when we're looking at their costing. Prime and conversion cost. Prime cost combine direct cost of direct materials and direct labor. Conversion costs are the cost to convert raw materials into finished goods. So you have direct labor plus your manufacturing overhead. To make cost information more useful, product costs for manufacturing companies are sometimes combined in different ways, depending on the manager's needs. Prime costs combine the cost of direct materials and direct labor. Prime costs are used by managers in organizations where the majority of the cost is associated with labor instead of machine hours. Conversion costs are a combination of direct labor and manufacturing overhead. When manufacturing process is machine intensive, managers may want to focus on the total conversion cost rather than tracking direct labor and manufacturing overhead separately. Now we're going to prepare an income statement and schedule cost of goods sold, manufactured for a manufacturing company and calculate the cost per item. So how do manufacturing companies determine the cost of manufactured products? Looking at the income statement, we're calculating the cost of goods sold, the gross profit, the operating income. So looking at cost of goods sold, we have the finished goods inventory account that provides information for the cost of goods sold section of the income statement. To find gross sales revenue less our cost of goods sold, and that's going to give us our gross profit. Net sales revenue minus cost of goods sold equals gross profit. When looking at operating income, our gross profit less our sales and administrative expenses is going to give us our operating income. So gross profit minus sales and administrative expenses equals operating income. The finished goods inventory account provides the information for the cost of goods sold section of the income statement. The cost of goods sold is subtracted from the net sales revenue to determine gross profit. The next step is to subtract the period cost, the selling and administrative expenses, to determine the operating income. Calculating cost of goods sold. So here we're looking at the income statement, and we're going to this exhibit shows the income statement for Smart Touch Learning once the company started producing its own touchscreen tablet computers. The activity that occurred in the finished goods inventory account provides the information needed for the cost of goods sold calculation. Cost of goods sold is a product cost. It is subtracted from net sales revenue to determine gross profit. Then, selling and administrative expenses are subtracted to determine the operating income. The selling and administrative expenses are considered their period cost. Cost of goods manufactured is the manufacturing cost of the goods that the finished production process in a given accounting period. Costs are determined from activities that took place in the past. The term cost of goods manufactured is in the past tense. It is the manufacturing cost of the goods that a company completed in the past. The cost of goods manufactured summarizes the activities and the cost that take place in a manufacturing plant during the accounting period. Calculating the cost of goods manufactured. This is a good screen to study. In order to understand how to calculate the cost of goods manufactured, it is important to understand the flow of product cost for a manufacturer. The flow of product cost begins with the purchase of raw materials. The manufacturer then uses direct labor and manufacturing overhead to convert these materials into work in process inventory. Think back on that. When the manufacturing process is completed, the costs are transferred to finished goods inventory. The direct materials, direct labor, and manufacturing overhead are all product cost because they are required for the production process. The finished goods inventory is the only category of inventory that is ready to sell. The cost of the finished goods that the manufacturer sells becomes its cost of goods sold on the income statement. Once the goods are sold, they are removed from finished goods inventory to cost of goods sold on the income statement. Product costs that remain in the inventory accounts stay on the balance sheet until the product is sold. Exhibit 610 shows a schedule of cost of goods manufactured. The company computed its cost of goods manufactured for 2018 to be $660,000. This is the cost of making 2,200 touchscreen tablet computers. This is a diagram of the flow of cost through Smart Touch Learning's inventory accounts. So we see the flow of cost here. The cost flows from raw materials, think of the ingredients to make the cake, to work in process. Everything's being put together and mixed and put in the oven to bake. And then finished goods, it's ready to go. It's ready for the market. Calculating unit product cost. Managers make decisions on pricing products based on unit cost. The cost per unit is found by dividing the cost of goods manufactured by the total units produced. The cost per unit is used to determine the cost of goods sold for the units sold to customers. So in this example, we have 2,000 tablets, and it cost us, our product cost per tablet was $300. So 2,000 tablets, product cost was $3,000. So our total cost of goods sold is $600,000. Knowing the unit product cost helps managers decide the price to charge for each product to ensure that each product is profitable. The unit product costs do not take into consideration any period cost incurred by the company. To find the cost per unit, you divide the cost of goods by the total units produced. The cost per unit is used to determine the cost of goods sold when products are sold to a customer. Now we're going to calculate cost per service for a service company and cost per item for a merchandising company. How is managerial accounting used in service and merchandising companies? Managers of service and merchandising organizations make decisions on pricing based on cost per service or cost per item. So you have, in this example, the total cost was $3,900 divided by the total number of services provided equals your unit cost per service. So the total cost was $3,900. We provided 1,950 services. So 3,900 divided by 1,950 gives us a unit cost of $2 per service. In this next example, the total cost of goods sold was $90,800. The total number of items sold was 260. So our unit cost per item was $349.23.